All right. So I think that we're rolling on YouTube. We should be good to go. What's up? What's up? What's up, everybody? So first things first, my name is Roy Dunia. I'm the co-founder of ChartAddicts. Welcome to the fundamentals for, we're still figuring out the name. It's the FX forecast. We're doing a news forecast, show you guys what the week looks like, show you guys some of the key things, and give you guys updates on the economy, let you guys know if we're in a recession or not. This stream is sponsored by TradingView, the #1 charting platform for traders. If you guys are interested in signing up for TradingView, click the link in the bio below. So two big questions that are happening two big questions that have been going around in the financial community amongst economists, amongst the Federal Reserve, is whether we can actually get away with a soft landing, which is this concept that the Federal Reserve can get inflation down. They can slow down the economy without crashing anything, without the markets crashing too hard, without people losing jobs, and without sending us into a recession. So I want you guys to kind of take down these words if you're watching this, because these are going to be the biggest themes going into the rest of the year. If you understand the core themes of like the main subject that everyone's talking about, you're going to have a much better chance of making money and of understanding how the game unfolds. If you don't understand some of these topics and you're not asking the right questions, then a lot of things are probably just going to slip, and you'll end up realizing that you're pretty lost on what's happening. So ask good questions. I'm going to try to make it as clear as possible, and I'm going to try to spell out some of the key concepts for you guys. So soft landing, we'll talk about what a rally is, recession updates, and then we'll look at labor statistics. So we can kind of use this as like an agenda of what we're going to do on this stream. Basically, I'm going to talk to you guys about a soft landing. What does that look like? What does the Fed really intend to do in order to get the situation under control? We're going to talk about a bear market rally, which is up until this point what most of us thought. So there's obviously two camps. I guess we'll just jump right into this for you. Okay, let me go through the rest of the agenda before I get ahead of myself. Then I'm going to go through the recession updates. Are we in a recession or not? Earlier this year, I was one of the first people to start calling for a recession because I saw the geopolitical situation in Europe start to unfold. Basically, I told myself, if this situation keeps escalating, we're definitely heading into a recession. So that's kind of where my mind was at. I was a bear, and I was pretty serious about, there were a lot of structural things that were like very shaky at that time earlier this year. Kind of, I want to say like May and June, right when the Ukraine situation first popped off. So major key to understand if, what are the main metrics that I was watching then, and what are the metrics that I'm watching now, and have there been any updates on those? So if you guys are on the Zoom call, if you guys want to ask any questions, go ahead and put them up in the chat. If you guys are on YouTube, you want to ask questions, make sure to put those in the chat. I'll go through them. Again, this stream is proudly sponsored by TradingView, the #1 charting platform in the world for traders. Let's go through the soft landing, and let me show you guys like the two camps in the economy right now, or amongst traders or amongst economists. See how multi-purpose the TradingView is? I'm just using it as my notes, kind of like my notes page right here. So pretty straightforward. There's two camps in the markets right now. There are people that are bullish on stocks, that are bullish on the economy in general. And stocks are a small representation of the economy. The real economy is things like, do people have jobs, the inflation rate? Like there's some very key metrics that we watch for to see if the economy is in good shape. The markets are a small representation because if people are spending money, stock prices tend to go up. If I'm spending more money at Walmart, Walmart stock is going to do better. If people are buying more Teslas, Tesla stock is going to do better. And so it's a representation of spending. It's a representation of corporate earnings, which makes up a huge part of the economy. All right. And so that's why it's very important to understand the difference between markets and the economy. And I'll be showing you guys how this crisis is affecting both. But again, back to this plot, there's two camps, bulls and bears. The bulls believe in something called a soft landing, which we just discussed. It's this idea that the Federal Reserve can get inflation back under control without sending us into a recession. Okay. The other one is a market rally. The Fed hasn't done any meetings all summer, not all summer, but basically all August. The market got a little bit ahead of itself. They thought like, okay, things are coming out. All the fundamental reports, the labor reports, corporate earnings, sentiment, manufacturing, everything looks healthy enough. And so everyone got ahead of themselves thinking that the Federal Reserve was going to start getting soft. And they think that this is a market rally. Eventually, everyone expects the economy and stocks to continue to the downside. So you're either bullish and you're like, you know what, we've let a lot of steam out of the markets. It's time for us to recover. Or you're a bear and you think that there's like the market's very shaky and all it takes is one thing to send everything spiraling again. Okay. I'm on this camp. So I'm right now, I would say I'm a bear. And real quick, let me see if I can turn on my transcript. Okay. Yeah, I have subtitles now. Incredible. I love technology, y'all. Okay. So if we're going to talk about those two options, which one's more likely right now? For most of the year, I've been bearish. And I've been looking at the four main factors of a healthy economy, which are the labor markets. A lot of people have jobs. How many people are quitting? The JOLTS job reports, the JOLTS job report, which shows us how many open jobs are in the economy. Inflation, are we getting the inflation situation under control? GDP, is the size of the economy, are we expanding or are we contracting right now? So all these factors I'm looking at to gauge whether we're getting closer to the recession or further and further away. So the way that my brain works is basically I have this meter and over here is recession. Over here is like neutral. And I don't know why I'm doing it like this. I think that recession is my base case, so I wanted to put it over here. But let me put like recession is over here. And I'm not even going to write it all out. Like best market condition is over here. And neutral is right at 0. And so I'm over here. And then as I started to see the economic situation weaken, as I'm starting to see the Federal Reserve tighten market conditions, which is inevitably going to make things slower, it's going to slow down demand. A lot of us are going to stop buying stuff. We stop buying cars. We stop buying homes. The interest rate is too high for people to take on personal loans. So spending comes down, even business loans. So corporate activity slows down, small business activity slows down, consumer activity slows down, and overall causes a slowdown in the economy. So I'm seeing this all transpire. And so I lean a little bit closer to the recession side. This is where I was at the beginning of the year when I started doing videos like, are we in a recession? Is the recession over? Like all these sorts of claims that weren't really based on the metrics at the time, but it was more forward looking. In hindsight, now I'm looking at the Q2 numbers come out. Q2 numbers did not come out that bad. When we look at corporate earnings, based on expectations, which is how markets work, it's based on the expectations that market analysts have set, and then we see the reality based on the expectation. But the expectation was that the Q2 numbers were going to come out horrible. And that wasn't the case. Q2 numbers came out pretty good and gave a little bit of confidence to the markets about where we are in terms of our economic health. If people are still spending and corporate earnings are still at record highs, that says a lot about the fact that we're not even close to a recession. So July and August, pretty good news all around. Corporate earnings came out higher than expected. GDP, not as bad as people expected. Inflation, relatively under control. Labor market, still very strong. We're chugging at 3.6 or 3.7% unemployment, which is very healthy. 3.5 is on the lowest end. 3.7, we're still close to the lows on labor. So where I am right now is probably, I've inched myself back and I've walked back from the recession scale. I'm probably sitting pretty close to neutral, but still leaning towards a recession. Now, how long this is going to take? This is probably going to be a 2023 sort of move. I'm going to walk you guys through exactly where we are. I'm going to walk you guys through what the Fed is waiting for and what the timeline is going to look like for what the Fed is going to need in order to pivot. All right. Nick Salas says, no more stimulus checks. Yeah, no more stimmies. No more stimmies, no more stimmies, no more stimmies. They might. So that's like the worst part about this situation is if Congress decides to send out stimulus checks, they're going to throw a wrench in Jerome Powell's ability to be able to fight inflation, and they're going to make the inflation crisis a lot worse. So that's one of the problems that we're battling right now. All right. Anybody have any questions so far? There's two camps. You're either bullish or bearish from here. We're looking at a few key features of the economy to tell whether we're headed into a recession or not. And if you guys get this, just let me know. Put something in the chat and at least let me know you're paying attention. By the way, did I mention that this stream is being sponsored by TradingView, the #1 charting platform in the world for traders? Those of you guys are new to the stream, my name is Roy. I'm the co-founder, ChartAddicts, another #1 education service in the world for traders. Great to see all of you on the stream today. We're explaining the fundamentals, news, and we're going through a lot of the updates on the recession and where the current state of monetary policy is. So Nick Salas says, we're spending money we don't have. The American people will pay that back one way or the other. Yeah, I mean, here's exactly how we're going to, there's only one way we pay it back. It's through taxes. Like we can keep printing, like there's two ways to introduce money into the economy, but there's only one way to pay it all back. Like they're going to have to take real money out of the economy, real money being money that's earned through labor, and they're going to have to put that into the paying ourselves back fund. So in the future, taxes will be higher. If you guys are hoping to get rich in the future, I'd probably set your targets a little bit closer. Tax rates will most likely be higher in the future just to be able to service a lot of these debt payments. Unless there's a giant monetary shift in the way that we do monetary policy, which I feel like there is. The monetary shift that I'm seeing is going into digital currencies and going into central bank digital currencies. But all that's going to do is create a more heavily regulated oversight environment rather than actually solve the problem. So I don't know. I think that in the future, there's only one way we pay this back, and it's through higher tax rates. And sometimes it's worth it. Like if you really think about it, which one is worse? Going into a full-fledged depression where no one has jobs now, or kicking the can down the road? If you're a politician who's trying to get reelected, you kick the can down the road. If you're a central banker that wants some kind of dignity and that wants to leave their job with some dignity, you're going to kick the can down the road. Nobody wants to be Jerome Powell right now, forcing the economy into a recession that we don't need to be in, or that we should have been in a long time ago. But he's forcing us into a recession to cure the problem. So basically, if the patient is if the economy is an addicted patient off drugs, Jerome Powell is a doctor that finally stepped in the room and said, we got to get this guy off drugs. No one wants to be that guy. Now you got a patient who's kicking, screaming, making a fuss, right? So nobody wants that role. Nobody wants to occupy that space, but somebody had to be the adult in the room. And thankfully, Jerome Powell is willing to, I don't know, just take one for the team. Shout out to Jerome Powell. As much flack as we used to give him, Jay Powell raised rates. Like we used to joke around about what Jerome Powell should or shouldn't do. Nobody would want to be in the Federal Reserve's position today. Just to be clear, me as an analyst and as a trader, what my job is to look at the underlying mechanics of what's happening, to separate things into, okay, if this happens, here's how the markets are going to go. And if this happens, here's how the markets are going to go. That's my job. Speculation, not really my job. And then getting on Jerome Powell's ass about what he should do, not really my job. Just letting you guys know. Sorry, guys. I'm talking to my media team. I know I'm spitting some heat here. I'm talking to my media team real quick. We're in the middle of some big projects. I am still running a show here. But let me know what questions you guys have before I really go into the major statistics that I'm watching to see whether we are in a recession or not. I told you guys a few of them. I mentioned labor. I mentioned GDP. I mentioned inflation, sentiment, corporate earnings. Let me know if you guys have any questions. All right. Do you think a lot of jobs will be lost? I'm going to answer that when we go through the actual landscape of what's happening right now. So when you mention Fed pivot, that means that they'll be less harsh with interest rates. Not sure if I asked that correctly. No, it's a great question. So a Fed pivot is basically whenever they start changing their mind. Right now, they have a specific strategy set. The strategy is we're going to be tightening monetary policy and slowing down the economy for longer. That's a strategy. As soon as they change their mind and they go to a new strategy, which is a lot softer, that's what a pivot is. Just think of a pivot. So yeah, everyone's watching for that. Because if you look at, let's say, any stock market index, let's go to US 30. By the way, quick for you guys. Yeah. Okay. That's a little bit too tight of a stop loss, but 31,880. 31,880. I'm looking for shorts. We might push up a little bit higher. I'll keep you guys updated on that. But just if we look at the higher time frames on any stock market index, when you see a shift, so this is what we mean. We've had a pretty positive July and August. And that's been the question the whole time. Was it a bear market rally or was it did we achieve a soft landing? In my opinion, we're still bearish. We've already kind of cleared around 70 to 80% of the previous move. If we clear the lows, we have plenty of downside left to the next demand zone. So like all the technical analysis aside, what I want to show you is we've been bearish. We've been going down since the beginning of the year, since Jerome Powell announced that he was going to be raising interest rates because of the inflation crisis. So we have a bearish market, July rally, because we don't have any FOMC meetings. We don't have any Fed speeches, nothing, no meeting minutes, nothing. So it's like when the teacher steps out of the room and they start a party. That's exactly what happened in July. Jerome Powell stepped out the room. Everyone launched a party. We started getting drunk. We had a recovery. Jerome Powell steps back in at the Jackson Hole conference and basically walks in on the podium, says, "You're all fucked. I saw what you guys were doing. We had a camera up." And he came to shut down the party. And we've been bearish ever since. Whenever the Federal Reserve says something, or they indicate a continuation of a specific strategy, or they indicate a pivot of their original plan that they had going, that's when the market changes directions. So if you can catch these lows, or if you can catch these highs, or if you can catch the continuations of the next retest, you will be very profitable in this market. Granted, you don't have to catch the whole move, right? You can catch pieces of the move, but understanding the overall direction gives you an advantage in being able to trade that trend over the next 2 months, 3 months, 4 months. So that's why we're looking for the Fed pivot, or that's why we're looking this Wednesday to see if the Federal Reserve confirms their original bias. All right. If the Federal Reserve wants to confirm their original bias, the markets will eventually continue bearish. I'm going to walk you guys through the mechanics of how this works. So if the Federal Reserve raises by, let's say, 75 basis points, which is what the market expects at this point, 75 basis points is the expectation. Hold on. There's a bunch of banging going on. All right, 3 scenarios. If the Fed does exactly what everybody expects, we have a little bit of a recovery, and then the market continues to drop. The little bit of a recovery comes from the expectation that the market like that the Fed was going to come in very aggressive, but they don't. So everything goes as planned, but there's a little bit of a relief rally here. The second option is if they come out very aggressive, more aggressive than intended, the markets will drop right away. And if they go softer than expected, the market will recover. So if you understand those three scenarios, when you go to trade any of the stock market indices or invest or look at how you should be moving your things around or which pairs to trade, or if you're trading any of the FX currencies, this is going to give you an advantage by seeing which outcome pops out on Wednesday. You're going to understand the playbook for the next month. So if I told you that you guys could understand the direction for the next month and you'd have that advantage in the market, who wouldn't take that? That's the beauty of understanding the news, understanding fundamentals, and understanding the bigger picture. Not recession related, but will UJ retrace to the 142.95 entry you placed on Enigma FX, or is that trade pretty much over? Bro, that trade was like 80 pips in profit this morning. That was not it was not a buy limit. If it says buy, if it says it's a buy trade, then it's a buy trade. It was a manual entry. Hopefully it doesn't retrace back to the entry. We got about 67 pips on the way up last night, and then we've retraced. So now we're probably sitting 22 pips in profit. If you got a late entry, you're probably sitting just above break even. So depending on the entry, your entry does matter. So if you did get a bit of a late entry, it's okay. 143.1, 143.2. If this is where your entry is, don't worry. Even if it retraces a little bit, trust that this is a higher time frame trade. I say that as I'm looking at it on the 1 hour. Higher time frame, is it, is it looking good? Is it not looking good? I'll be completely honest. We had a nice bullish push to the upside and we're still creating higher lows. So as far as I'm concerned, this is still pointing in the bullish direction. The candlesticks themselves and the way they're forming is not giving me a lot of confidence, because we went from having wick rejections to filling these wicks with these solid candles. What I would really like to see is a daily candle close above these highs. If we close above these highs, I'll feel a lot better about this trade. And this, this thing will have a lot of potential to run. So 143.5, 143.6, that's where we're looking to close above. Your entries are anywhere from like that intended 142.9 all the way to 140 or 141.9, all the way up to 142.2. So 30 pip range here. I know it's a pretty wide range, but anywhere on those wicks on the daily, you're pretty solid. The housing market interest rate just recently hit 6%. Yeah, it's going to get a little bit higher. The more that the Federal Reserve raises interest rates, the higher that car loans, mortgage rates, the higher they're going to get. Which is another reason why in these environments you want to get a fixed rate mortgage, or like in the, let's say, let me make sure I say this correctly. The past 10 years, it would have been a good idea to lock in a fixed rate mortgage. Because like if you look at the Federal Reserve's interest rate was sitting at 0%. Let me actually go to this. So if the rate for banks to borrow from the Fed was 0%, they were lending to people at the mortgage rates anywhere between 2 to 4%, 4% being on the highest end. A lot of people that were able to lock in mortgages for anywhere between 2 to 3% after the financial crisis. So imagine that your interest rate goes, like if you've locked in a fixed interest rate, now if you want to go get a house, they're going to charge you 6%. but you can keep your house for 3% interest. And if you go and look at the monthly payments, the difference between a 3% interest rate and a 6% interest rate, huge fucking difference. You won't be able to afford the same house. And so that's the importance of if you had been able to lock in a fixed rate. Now, if you have an adjustable rate mortgage, as the interest rate starts to go up, so does your adjustable rate. So now you're paying more every single month for the same house. That's where the problem comes in. Because if you got a specific house based on what you could afford to pay at the time, and now your interest rate doubles, your interest payment every month just doubled. If you're no longer able to make that interest payment, you're going to sell the house, you're going to list it on the market, and you're going to move somewhere cheaper. And so those are the sorts of things that we're looking for to see if we're getting closer to a recession. If people can't pay off their loans and they start to default, that's getting us closer to the meter that we talked about, right? That scale of recession versus no recession. We're tipping back over to recession side.
We're recession. We're having a recession, bro.
My dude. What's up,
good. How are you?
I'm good, bro. I was actually
what I miss
why we're not in a recession.
Yeah, really?
I had to walk it back. You heard me. I mean, bro, earlier this year, I got a little bit ahead of myself. So we're already in a recession. We're in a recession. I was walking them through the 4 major factors to dictate whether
we're not in a recession yet because we have 10% inflation. So we have one. It's one or the other, bro,
Yeah, I think that's what the Fed's going to do is the Fed is going to keep tightening monetary policy until we hit the recession, which is basically that's when labor starts to take a hit. And that's when corporate earnings and consumer sentiment take a hit. Right now, all 3 of those are still positive. Labor market strong, consumer sentiment still strong, and then Q2 numbers for corporate earnings came out way higher than expectations.
Right.
So I think that we're going to keep, and dude, this is like, what's fucked up is this is like summer 2023 shit. If the Fed keeps tightening until there's a recession, and that's what they mean by tighter for longer, then we could see a recession in 2023.
I mean, yeah, well, they said they're going to keep rates high all throughout 23, bro. So like they'll probably start QE again in like 24 potentially, but it's just not sustain. It's just prices are just not sustainable. The problem is, bro, like that we have so much debt, bro, like, and all these debt are collateralized into assets. And now when the rate goes up, guess what? All your debt that you have, like all these assets are not bringing you a return because it's too expensive. It's not sustainable. So I don't know, man. It's a very unique time. But I don't see a way out of this without causing the soft landing. I just don't think is feasible. But like I think there's some type of middle ground, but we're gonna see there's gonna be pain. There's gonna we had so much euphoria like the last year or so, year and a half, whatever. So we're gonna, I think we're just getting started, bro, to be honest with you.
For sure. Like these things are still strong. And so I'm keeping my eye on them just to basically see like, okay, are we getting closer to a recession or further away?
Well, the unemployment rate did start ticking up a little bit in the last release. So like maybe unemployment starts to kind of raise a little, and I mean, I don't know. I mean, I think Powell is going to be very, very hawkish this week, I think.
Like if you look at the interest rate, imagine there's like a support level here.
Yeah.
We don't have to imagine. I'm gonna draw it for people. There's a massive support level right here.
Right.
So yeah, we've ticked up, but like ticking up from 0 is like, this looks like XRP's price right now.
Literally.
And so, I mean, same with XRP's price. We got a lot of room to the upside. I think that as soon as labor breaks, the Fed's gonna pump the brakes on tightening.
Right.
And so they're literally like, Jerome Powell doesn't give a fuck about financial markets. He's looking at this and says, as long as this stays in the lower bound, then they're going to continue to tighten.
All right.
So got a long road ahead of us.
I agree. Interesting. So what you think about these, what do you think about these indices, bro? You think 75 basis points this week or 100?
75. He ain't doing no 100.
He might, bro. I don't know.
No, he's a pussy. No, I'm gonna be honest. Like if he wanted to get this over with, like nobody wants to be the Fed chairman that broke the economy.
I mean, Paul Volcker, bro. Like Paul Volcker was literally a hero. And even Powell said, or I was reading an article this morning about like, I think Powell said this, that he said, I respected him because he did what he thought was right. And I feel like that's why I was reading something basically saying, in the July FOMC release, they were just very, I feel like their intentions were kind of misunderstood. And that's why Jackson Hole, he was very like shrewd and to the point. He was just like, bro, in 8 minutes, he said inflation like 69 times, bro. So it's like, it was just inflation,
But you keep
inflation, inflation,
changing the
inflation.
number.
It was 68 or 69. It was like 68 or 69 times. I don't remember. I'll go back and count. I'll go count.
He
that
was like,
shit,
he
bro.
said inflation 420 times in 8 minutes.
Yeah, and then he smoked a blunt after.
No, I feel you. He did have to make a point. The thing is, if Paul Volcker, if it didn't work and inflation spiraled out of control, they wouldn't have written the same about him.
Yeah, it would. Yeah, right. If I
So
didn't go full margin, they wouldn't write about me either, bro. But
So if the trade goes your way, they're gonna write about you.
yeah, exactly. But I feel like that's what they had to do. Like that's what was necessary, like for that moment. Obviously those but the thing about it today is those type of interest rates are just not feasible, bro, because it's like I said, it's too much debt, and like those assets that are collateralized into those debts are just not gonna perform, bro. So it's a very interesting where it's a rock and a hard place, bro. But I think I really, me, bro. I'm a bear till I die, bro. So
So I explained the two camps. So like there's the bulls right now, and then there's the bears. And you mentioned
I definitely see us at a bottom. We're at a bottom, but I don't think I think we're smashing through that bottom.
So these people that's exactly what I was thinking. This is like a bear market rally.
Right.
So you're either a soft landing person or you're a bear market rally person. And obviously, bro, we've already retraced probably 80%, and I'm going to measure it right now, but we've probably retraced 80% of that July rally. And so I'm starting to think that like, yeah, that was just a rally and we're headed back down.
Right. Just look at, bro, if you zoom out, just look at the higher time frames, bro. It's pretty bleak, bro. It's pretty bleak. Like that CPI really just accelerated the momentum, bro.
It did. Oh, actually, okay. So
we are at a support. We are at a decent support right now. I definitely agree.
This is Jackson Hole.
Jackson Hole was the next the second. No, it's no, it's not that one. It's the left to the left more.
Right here?
Yeah, that one. Yeah, that one. No.
Oh, Jesus Christ. See, this is just disrespectful.
Yeah, that was Jackson Hole. Then the second arrow is CPI.
This one?
Yeah.
Okay.
But it's just pretty clear to me. It's like, it's very sharp drops and these slow, retracements, bro, that are kind of just dribbling out. But overall, yeah, like something like that, bro. Yeah, that line is pretty accurate, bro. To be honest with you.
No, I feel that.
We're on thin ice, bro. We're literally like the polar bear on melting ice, bro. And our ice is melting every day, bro,
For sure.
So I don't know.
Okay. This week, first off, yeah, we are pretty low in the markets, but we're pretty shaky. This is the July rally right here.
Yeah.
And so I was explaining to everybody, like when there was no Fed meeting in August, it's like when the teacher steps out the room.
Right.
So it was a party the whole time. And then as soon as people found out, okay, inflation is still running hot, that's when we got this little dip back in.
Right.
And then Jay Powell stepped back in the room to make sure everybody.
And it makes sense in terms of liquidity, bro. Like if you look the May 4th, like those highs, like on May 4th, where right, like the hike, a little bit to the left, no, a little bit, yeah, like price ran right through like just above those highs, bro. It was a very interesting. I mean, I looked at it as a liquidity grab, bro, because at that point, everyone and their mother was short. After those lows were printed. So to me, it was that 34,000 was a really nice price for some shorts to get collected. It's like if you look left, it's just a really dynamic area of price. And I think now we're ready to we're in full bear mode, bro. Yeah, we might get a little short-lived bounce here and there, but we know where we're going, bro. Honestly, bro, like I said it on the charity stream, I'll say it again, but I do believe US 30 is going to go to 18,000, bro.
Bro, relax.
18,000, bro.
You said that, bro. I made some wild claims on the stream. First off, I got to call my attorney and I got to sign some kind of form because I said I was going to eat a shoe if crypto doesn't hit 100K. Right. David's chopping up the videos. He sent me the clip. First off, I was on 3 hours of sleep. Okay, so I was under duress. So nothing I say stands.
Nah. You're gonna eat a shoe, or you're gonna be a laughing stock of the trading community.
Bro, that's just not gonna happen.
I'll have Jason chop a video of someone eating a shoe and
Hey,
put your face on it.
Yo, bro, did you know that the Expert Trader podcast is now sponsored by TradingView? And so is this stream.
Really?
This stream is now sponsored by TradingView, the #1 charting platform in the world for traders. Click the link in the bio.
They cut that check?
Click the link in the bio. Click the link in the bio to get access to TradingView Premium.
It must have cut some type of nice something.
And make sure to click that link if you guys want to get your pro account. So
we got to do a solo podcast, bro.
Yeah, bro, we were supposed to do one on Friday. I'm pretty sure you faked.
I mean, bro, you know me. I like the in-person. Like, just let me know, bro. Let me know. Catch the flight, bro. Make another 200 bands.
Bro, I'm moving down there too.
Yeah, facts.
We'll do one in person for sure. I got a crazy idea for you, actually. As soon as I pull up, we're gonna shoot something, but I got this crazy new series.
What is it?
I can't say it right now.
New series. Okay.
I'll call you after and let you know.
Someone said just eat a shoe made of cake. Never specify what kind of shoe. I mean, yeah, like as long as it's resembles a shoe, like it's cool with me.
Y'all figured it out.
And it has to have a rubber sole though.
No, my dad sent me the video. There's like some guy eating a cake shoe.
Really?
And he was like, "Yeah, Roy, you've said some wild shit before. Like, you might need this. Get yourself out of it." No, bro, this is actually really funny. I'm gonna have to show you guys this shit. This is gonna geek you guys. Somebody found a video of me from like early 2021 saying that Bitcoin was gonna hit 100K. Now, granted, this is before the major rally. This is before like the giant bull rally, and so we got pretty fucking close. This was at like 35K. I made this claim, but
100K by the end of 2021, I will eat my shoe. I'll eat a piece of my shoe. All right, I will eat my fucking shoe, a dirty shoe, not a clean shoe, not fresh.
Hey, so you gotta eat two shoes now, bro. If you don't fucking
no. I called the verso. No, see, bro, see. I had to think of the shit with the risk and reward, and so I doubled or nothing. So the bet I made with you about crypto breaking highs by 2024, I told him I would double or nothing. If I lose that bet, I'm gonna have to eat 3 shoes.
All right, I got a shoe for you.
But if I win that bet, I ain't eating no shoes.
I got a nice shoe. I'm gonna give you a Timberland boot to eat.
That's the most thing I've ever fucking heard. A dirty Tim.
Nah, I'll get you some clean Tims, bro.
Disrespect. No, look, this is option 2. I could see this happening because we had shallow. We can't keep having shallow, like, unless it just fall. If it's gonna fall off the cliff, it's gonna fall off the cliff.
Bro, who's buying stocks right now, bro? The Fed ain't buying the stocks, bro. So who's buying them?
The fucking bull crowd, the soft landing.
What bull crowd, bro? There's no bull crowd.
The soft landing people, bro. I swear to God, like every third economist is talking about soft landing. You know, we may have misjudged the fact that the economy is stronger than we thought. Bro, they're everywhere. Larry Summers, the most well-respected economist in America, Harvard professor Larry Summers, talking about labor is strong, talking about corporate earnings came out higher than expected. Even he's on the bullish side. Got me second guessing myself. Now I'm better than that. I looked at the data. The data doesn't lie. We're still shaky.
The data is bleak, bro. The data is bleak. And like even like small, I just speak to a lot of small business owners, and like just because people aren't unemployed doesn't mean that they're actually like adding to the workforce, bro. So I just see that there is still a lot of open jobs, bro, you know, available. I don't know. We'll see, bro. We will definitely see.
All right, let's go through some of this data, because honestly, bro, this is like my cheat code. I've been telling people this. I'm using this call as a chance to do my research. I don't have a lot of time to go through and do my research. I'm gonna be honest with you. So everyone's gonna like join me while I do some of this research. I'm gonna go through the Bureau of Labor Statistics site, look at some of the key metrics, and see if we're getting better. So 3.7% unemployment. Obviously, we're moving. CPI is up 0.1% in August. Okay, payroll, producer, PPI, not too interesting.
Remember, that's CPI going up after we already raised rates, what, 2.5%, or, you know, whatever the number is. So that just goes to show you that like we still have a lot of inflation, bro, you know, even after what we've done already.
That's true. We have a lot of, the Fed has so much room to tighten. It's kind of
Yeah, bro. If you, bro, on all
a
the
lot of them.
bro, all the indices, if you bought stocks anywhere from before the rally, bro, like, you know, anywhere but pre-pandemic, it's still above those points. So I think we got a lot more money, you know. But I would love to see a rally, bro. I'd love to see price come back up to like that 32.5 area would be lovely, bro. It all depends on how the market goes, how the meeting goes this week for me.
I'm gonna call it right now, 32,800. 32,800.
32.8, that would be crazy. That would be lit though.
Let's look at GDP real quick. Oh, god damn. Bro, GDP is strong. GDP is still strong. I don't know. How do you read this data? Is this because we printed $20 trillion?
Well, yeah, that's the thing is how can the GDP not be strong when we're just giving out candy drugs, bro, you know, to everybody.
Well, I mean, now they're taking 100 billion out of the economy every month. They're still tightening. You know, they're still getting demand down.
What's 100 billion to 17 trillion, bro?
This is true. That's 100% true. This is why honestly, like, the economy is in good shape.
Right.
Because like the money's still out there. People are hoarding, like institutions and corporations hoarding money is very different than there not being money in the system.
Right.
They're just being smarter. They're not hiring or investing in research and development. It doesn't mean they don't have money. They're all breaded as fuck.
Well, yeah, look at all these companies laying off, you know, employees and all, you know, doing all these cuts, budget cuts, all that stuff. It's they know what's coming, bro. They you know, they all know what's coming, bro.
I'm looking through.
I think it's gonna be a wild winter, bro. Wild winter.
Okay, so that's the biggest thing. Okay. So
I'm gonna be buying my oil. I'm gonna be shorting these stocks, you know.
Yeah,
I'm
if we're gonna talk about the timeline that I mentioned earlier, how the Fed's gonna be tightening for longer because there is those labor, inflation, GDP, everything is still strong. This is where we are now, and let's say this is the end of the year. At any point between now and the end of the year, if something happens in Russia and Ukraine, the whole thing falls apart.
One thing cracks, bro. One crack in the armor.
That's all it's going to take. And that could be Russia, Ukraine. That could be an escalation in Taiwan. That could be Russia keeping energy from.
Because remember, Ukraine just said that they still want to join NATO, bro. Like they literally said that the other day. They're like, yeah, we're still actively pursuing membership in NATO. Like that was the whole reason the war started, bro. So there's no way that conflict is gonna stop. I don't think, and it's probably only gonna escalate because if NATO gets involved, then we know what's gonna happen. Look, then we have World War III, bro. You know?
No. I think the U.S. has started to. I think the U.S. has really started to understand the game, which is okay. We have an obligation to our EU or to our EU allies and our NATO allies that are around Ukraine. We have a civil duty as the kind of superpower in the world to protect Ukraine and protect liberty to a certain extent. But there's a difference between doing that shit and like Ukraine and their own problems and their own, you know, national shit. And
because they already had a civil war going on the eastern Ukraine. So like that's where a lot of this problem started from, was just, you know, I mean, from that.
Okay, obviously I'm a nobody and my opinion doesn't matter. But if anybody out there was listening to this who is an actual decision maker, hopefully the US stays the fuck out of the situation and they don't let Ukraine in NATO. That's the number one thing that we need to do. We find the most diplomatic situation possible. Ukraine eats shit and just starts letting the Russian speakers on the certain places in the Donbass region and all these other places that are key areas, allow them to live and allow the Russian speaking Ukrainians to do their thing. And Russia needs to like take the dub. We give them a nice place to retreat and they fucking stop holding the energy hostage. So we don't have a European energy crisis. If we can do that, we're good. If they're going to keep poking the bear, it's going to be a long fucking year.
I would love to poke the bear, bro.
I know you would. We're going to go in there and just throw the whole beehive at the bear. See what happens.
I'm going Khabib on that bear, bro.
Son, all it takes is one thing.
Yeah, exactly. That's why I think the likelihood of us going down is just way higher because it's just too much uncertainty and one crack in the foundation and it's over, bro.
Let's look at PCE. This is the Fed's #1 measure of inflation. It's not really, they'll do core PCE and then we'll do PCE. So this is what actual consumers spend money on. Inflation's still chugging higher than ever.
Chugging, bro. Chugging.
If we look at the 1 year, well, this is as of July, but people will be like, oh, it's flattening out. It's flattening out. But this is fucking horrible. This is, 75 basis points guaranteed. If he does a full percentage point, bro, I'm telling you, the markets, that first scenario that we said.
Yeah, little blue. Yeah.
Yeah, this is
big
full
blue.
basis point.
Big blue.
This is 75 basis points.
You think?
And then this is 50 basis points.
That's overzealous, but you know.
No, I'm telling you, if he does 50, they're gonna be like, "Oh, Jerome Powell's a pussy," and the economy's strong as ever.
I don't, bro. I really just based off of what he said at Jackson Hole, bro. Like I couldn't see him doing 50 or even 75 is still like a if for me, bro. I really think 100 might be. I think he might just shock. I don't know. We'll see. It's probably gonna be 75, but
what's been the Fed's biggest weapon this whole time? It's not even policy. It's like Jerome Powell scaring the market in advance, like getting them to release a lot of pressure, and then the news comes out, selling the rumor, buying the news.
Right.
So he's been giving the markets a lot of opportunity to sell the rumor. Jackson Hole doesn't actually matter for anything. In case people were interested, even though the markets fucking fell out of the sky. No, like
it's only what was said. It's what was said that made the markets fall out of the sky.
For sure. He's going to pull up on Wednesday and just have a much more neutral tone so he doesn't panic the markets. And he's going to be like, yeah, everything's all right. And so that's where I feel like if he does a 75-point hike and he doesn't reiterate the same things he did in Jackson Hole, we're going to have like a nice recovery back to the 70 or 80% fib. Like this is the 75 basis point scenario. Because everyone's going to be like, okay, well, it's not an emergency. This is not an immediate emergency. We still have a lot of room to tighten. So this next 75 basis points is not going to change the game because we still have a whole nother 2 or 3% down the line. And so the market's going to recover a little bit. Then they're like, oh shit. They really, really meant it. They really raised the interest rate.
All right.
And that's when reality sets back in. I wish it wasn't true, man. Wish it wasn't true. So PCE still chugging. Okay. 2 big tailwinds that I think are very important to note. The only reason that inflation numbers are starting to look better is because gas prices around the country are down significantly. So we look at the national average gas from
AAA. That's all because of just stimulus, bro. Like, releasing reserves and all kinds of shit like that, bro.
Exactly. So it's not sustainable. That's the biggest key. Regular hit $5 highs, 5.80 highs. We already went through this. The current national average is 367 for regular and 440 for premium. So we're down significantly from the highs. This is what's going to affect core PCE versus PCE. Core PCE not including automobile sales and core PCE not including energy prices, food and energy. So I mean, this is pretty good, and I think they're going to keep these down as long as we're in this election cycle. So midterm elections is a big driver for how aggressively they go with these policies of either giving out stimulus or if you want to win an election, get gas prices down and send people free shit or at least promise them free shit. And that's what I think they're doing here with the gas prices. He's willing to dig into the reserves however long it takes for the Democrats to have a chance in the midterms, which they don't anyways. So he should stop digging into the reserves. Again, just my opinion.
Yeah.
Just eat a shoe made of cake. Okay. What do you think about XRP to the moon? That's what I think. Hit the like button. Yeah, I agree with that.
Smash the like button. Smash that button.
Yeah, go ahead and smash that like. Oh, go ahead and subscribe too. This is your first time on the stream. So, ladies and gentlemen, we went through some of the key metrics that I'm watching for. If you guys are looking at an economy and you want to gauge the health of an economy, just remember there's 4 main factors that we're watching for. One is the GDP, which is basically the size of the economy. It's either expanding or contracting. Talk about inflation, which is the rate change prices. We have good thing I don't get paid to spell. Employment, I'm like borderline dyslexic. Inflation, employment, and then you can put sentiment and earnings in the same category, which is, are people still spending? How are the consumers doing? Those are the four main factors. So far, GDP still doing decent, inflation still running amok, employment still healthy, and corporate earnings and consumer sentiment still pretty healthy. If any of these break, if inflation starts to go higher for no reason, just all of a sudden it continues to tread higher, even though the Fed's getting aggressive, red flag. If the GDP starts to decline dramatically, red flag. If the employment, if labor gets hurt at all, we're at 3.5, 3.7. If it starts to move up into the fours, red flag. And then if corporate earnings and if consumer sentiment starts to take a hit, that's a red flag. These red flags mean we're going into a recession or we're getting closer to a recession, and you should prepare yourself. If these things continue to stay strong, then the Fed will continue to tighten until they cause a recession. A recession is inevitable because the Fed is going to keep tightening until they reach it. That's their like milestone. They're not going to stop until they hit a recession. So we have to hit a recession. So that's basically the economic landscape today. Any questions, comments, concerns before we hop off?
Sounds good to me. Let's get a recession going. Let's get a depression.
Yo, I don't want to wish that on anybody, for real.
Of course not.
If the markets do crash, you guys better take advantage. You're on the stream.
Yes, sir.
Can't say I didn't know, but I didn't know.
I'll see you all at 18,000.
Bro, if it hits 18,000, I promise you, we have way bigger problems.
Yeah,
Your broker's gonna shut down and just dip.
Yeah.
So you'll be like, well, no regulators are at their office. Everyone's gone now.
Yeah.
Shake that thing, Shotty. Also, will S&P retest 3,700? What the fuck kind of question is that? I can't even take that seriously.
Oh, yeah, I'm gonna hop off, bro. God, good seeing you as always. Let's touch base, bro. Tell me about that series you have going.
Bro, I'll tell you right now, it's gonna shake the game.
All right, let's shake it up.
Industry.
Let's shake it up.
All right, brother. Good to see you.
Likewise, bro. Take it easy.
All right, everybody. Happy safe trading. If we can go through some of those trades from the Signals app, Euro USD still sitting at entry. After this next dump, I think I'm gonna put my stop loss and break even. But I want you guys to understand how this thing works. You get an area of consolidation. You get the first fake fall to the downside. Then you get a recovery all the way back up. You guys can't see my screen, can you? I'm not even sharing my screen. It's a little embarrassing. Okay. Quick update. Euro USD. This is what I was showing you guys. There's a period of consolidation that happens right before the market's going to sell off. Bunch of wicks to all sides. Then you get the first sell-off, which breaks the lows. Then you'll get a recovery that breaks the highs. And then eventually you get a closure back under the lows and a sell-off. That's kind of the situation that I see forming here. We had a consolidation right here. We had the first kind of fall to the downside. Then we had a break back up, a fall and a retest. I think as long as we can stay below the 1.0, we're going to short to the downside. If it's not the 1.0, then we have like 1.025. That's the area I'm watching. That'll be a lot later in the week. All right. And then last but not least, UJ. UJ, still sitting above entry, looking pretty good. If you guys ask me, hold it. And yeah, any questions?